To our top story this half hour, markets shaking off trade tensions. President Trump using the stock market as a measure of who's winning the trade dispute and indicating that the U.S. has a clear lead over China. Listen to this.
If I didn't do anything with the trade deals, if I said nothing, let everybody continue to take our jobs, take our wealth, let them continue. I'll bet our stock market's up almost 40% since I won. But if I didn't do anything with trade, just kept quiet, let them continue to take advantage of us. Nobody says anything. I think you would have been up another 40, 50, 60%. But eventually, you would have had to pay the piper eventually. And we're not going to do that. We're going to do something. We're going to make our country so much richer than it's ever been.
Joining us now, Paul Christopher, Wells Fargo Investment Institute head global market strategist. Paul, why has the markets been able to shake off the trade tensions, the trade worries so much?
Well, the market believes, and we agree, that a deal is the ultimate goal here, that the goal is not to run the Chinese economy into the ground or the U.S. economy into the ground with unending tariffs. If they can get a negotiation on the trade deficit, getting the Chinese to buy more from this country, and if they can get a deal on autos with the Mexicans, the Canadians, and the Europeans, then we think the trade talk, the rhetoric, dies down a bit or is dialed back.
Hey, Paul, Mitch Rochelle, you mentioned China and their economy. Some of the challenges with their economy sort of predate the trade war. Their markets are sort of in free fall, their currency is diminishing, and their growing middle class and the funding of entitlements for the middle class is sort of really starting to put pressure on their ability to grow. And you see that in their GDP numbers. So regardless, don't we still have a global challenge with China's economy that's going to impact other global economies if this trade war isn't sorted out?
Well, you're absolutely right, Mitch. The moderation in growth around the world, Europe, I would mention, too, has slowed down some. That is confusing the markets a little bit here. They're thinking that all of the slowdown is related to trade talk. It's not. The slowdown is predating the trade talk, and it's an important factor. The Chinese, we need to remember, the Chinese have an economy that, on the one hand, has very strong consumer growth, and on the other hand, has a lot of debt, and as you mentioned, some issues with providing social welfare. So how are they going to balance that going forward? They need to be very careful with that, and they don't need the extra variable in there, if you will, of trade uncertainty. So we think there's pressure on the Chinese internally to come to the negotiating table.
Debt is a huge issue, though, Paul, and let's talk about what we're paying as a nation to borrow right now. J.P. Morgan Chase CEO Jamie Dimon warning investors over the weekend to prepare for 5% interest rates. That would be the yield on the 10-year Treasury. And this certainly is a major concern. It's not showing up in the markets so much at this point, but now that we're back to running $1 trillion deficits, we're in a fight with one of the largest holders of our own debt, someone we've leaned on, China, and relied upon to buy our debt and fund our deficit. Your reaction to this, is there any way in the near term that we even get back to 4% on the 10-year yield?
We don't think that there's much chance of getting back to 4% anytime soon on the 10-year yield. Yes, the debt is a weight on the economy, call it a headwind for growth. And no, we don't think the Chinese are about ready to dump their holdings of U.S. Treasuries. Treasuries are simply the largest and most liquid market in the world. And if you're a government that needs to hold trillions of dollars of reserves, there's no other place for you to go but to hold U.S. Treasury. So we don't think there's a real threat there. But yes, the debt is going to be a headwind for the economy going forward. On the other hand, you've got still quite a demographic challenge going forward as many of us age and get into the retirement years. We're going to be holding a lot more debt anyway. That's going to help keep yields a little bit lower. Our target for the 10-year Treasury this year is in the low 3s, and we don't see it moving up to 4 anytime soon. Rather, low yields look to us to be continuing to be the main problem for investors.
Well, is an aging population and those who will be holding more safe, if you will, Treasuries, is that bad for the stock market then?
Well, what it does for the stock market, when the yields are low, relatively low on Treasuries, we've been hanging around 3% here, that means that you can have a little bit higher stock market prices before stocks get overvalued. So we don't think that stocks are too rich right now, and part of that argument is that the 10-year is just not making the sort of headway that would get you to 4 or 5%. If we were to see that, we'd be more worried about stocks.
Paul, going back to, Mike Baker here, going back to the tariffs question, there's a bit of a softening in the talk between U.S. administration and the EU now and the tariff skirmish. Do you expect the same development in our conversations with China?
Well, the Chinese, I think the Chinese know that there's a deal available for them anytime they want to take it, but they're just not sure whether they should go now or later. We think there will be a deal sometime. There's a good window for that opening up in the fall, but the Chinese simply need to figure out a way to close some of that trade deficit. They could buy more liquid natural gas. They could buy more crude oil. They could buy more soybeans. Certainly, they need all of those things in greater quantities than before. And I think if they were to do that, they would come a long way towards meeting the president in a deal. So I think that's in the end where they'll finally go, is making some kind of deal on trade. The U.S. and the Europeans also have some talking to do. Not a done deal yet there either. But again, the president probably wants to see those two things, some sort of deal on autos and some sort of deal with the Chinese on the trade deficit. And then we think that the trade negotiations sink to a lower priority and for the markets, and we can get back to thinking about good earnings growth going forward.
Paul, real quick, why is the opening in terms of having discussions with China, why is that in the fall? What about the timing of that?
Well, you've got the midterm elections coming up here in the U.S., and the president is still putting out there additional tariffs, and the Chinese feel obliged to respond. I think they're still gauging each other's degree of seriousness. The president, in our view, since the beginning has been serious, but some people maybe have been thinking that well, he would eventually bend or make exceptions. That's not been the case. So they need to get back talking again. There's some evidence that the Chinese are interested in that. It just has to happen sometime in the next few months, we think.
And the stock market just keeps chugging along. Paul Christopher, thank you so much. Take care.
Thank you.
Come back soon.